Hey everyone, hope you're well and welcome to The Loft. Now today I wanted to go over the differences between the UK and the USA savings wrappers. Obviously due to this being from different countries it can slightly be hard to align, but that's not going to stop us and we're going to give it a go so that we can compare them between each other. I will be looking at the ISA for the UK and also the Roth IRA for the US. I would also like to try and include something for the EU, but to my understanding the European Union don't have an overall tax wrapper account that we can use. I am aware that individual countries have their own particular tax wrapper accounts, such as the PEA in France, and some countries entirely don't have any options, like I believe Ireland don't have an option for tax wrapper, so really sorry if you're from Ireland. And let's go on and see the differences between the Roth IRA and the UK ISA. So let's load up a chart and see where the areas align, and I will be going through and essentially applying points to what I feel is the better option for general people and what I would prefer to use if it was my account, for example. I will then be using this point system to try and work out what is the better account for people to use in all, but this is entirely personal and subjective, so you may have a different opinion to me, and obviously that is not a problem. So before we actually jump into the scoring, I just want to touch briefly on what both of the different accounts do. So starting with the US, they have a Roth IRA, which is an individual retirement account, which is accessible to residents of the US. The idea here is that any money that you have already been taxed on can go into that particular account, into whatever investment you choose, and any gains and proceeds from that are tax-free and are protected from tax by the IRS, I believe it is. And this allows people to save and grow funds more effectively for retirement. Then on the other hand, we have the UK ISA, which is an individual savings account. This is again a tax-free wrapper and it allows you to put money in, save money and grow benefits in the form of interest and potentially stocks without being taxed on the benefits or proceeds from that. So overall, both accounts are designed to essentially do the same thing. You put money in, any gains you get are completely tax-free. But now let's jump into the nitty-gritty and more about the differences and the similarities between the two accounts. So I think one of the best places to start would be how much we can actually invest and put into these accounts every single year. And this one is relatively straightforward. For America, the value is $6,000 or $7,000 if you are over the age of 50. And if you put more than your allowed limit into a Roth IRA, the IRS will charge you 6% every single year in tax until that money is then removed from the Roth IRA. Whereas in the UK, we have a limit of £20,000, which on a comparative basis is around $27,000. And in the event that we overpay into the ISA, what will happen is the UK HMRC will make you pay tax on that money that you've put in, the same as you put it into a normal account. So you lose the tax benefit. There can be essentially some more harsher measures. They can look into you a bit deeper and find out what's going on. But generally, it's a case of anything you've put in over the limit will get taxed as if it's in a normal account. So for this one, I am going to have to give the point to the ISA over the Roth IRA. And the main reason for this is that UK residents have the ability to save 3 to 4 times more money than US residents with the Roth IRA. So now that we've cleared that up, let's move over to the next one, which is the sort of assets and benefits that we can get from using the ISA. These are relatively the same, but there are some slight differences. So looking at the Roth IRA, you can have assets such as cash, stock, bonds, funds, but you can also have things like physical real estate and physical gold. So that is something that we don't have in the ISA. If we look at the UK ISA, we can have cash, stocks, funds and bonds, but we don't have the option of physical gold, physical real estate or anything like that. The additional thing with an ISA is we have to have it split out across different accounts. So for a cash, we would have a cash ISA, and for stocks and shares, we would have a stocks and shares ISA. Overall, the limit on all of the accounts cumulative is £20,000 as mentioned before. So in this case, I am going to have to give points to the Roth IRA over the ISA. And the main reason for this is the variation of the assets that you can actually put into the account, such as physical gold and physical real estate. Now, let's move over and see what benefits are essentially available and bonuses are available for each account. For the US and your Roth IRA, you can, as far as I'm aware, get employer's match to pay towards your Roth IRA, and it doesn't count towards your $6,000 per month limit. What this means is if your employer does offer a match scheme of say 1-to-1, you could put away $6,000 and they would also put away $6,000 for you. Therefore, you could actually double the amount of money that you can save in your IRA, making it a total cap of $12,000 rather than $6,000, which is available for generally using the account if you don't have an employer's match. I am aware that not every employer does offer a match scheme, but if they do, it is essentially free money. Whereas if we jump over to the UK and the ISA, we don't have an employer match scheme. We have that as default for our pensions that we have to pay into by law, but for an ISA, we don't get that benefit. So if we do set up an ISA with our employer, we can sometimes dodge certain fees and certain trading fees and commission fees. However, we are also slightly limited on the sort of assets we can buy. Generally speaking, UK company ISAs are more like the Vanguard options that you can get with set investments and set funds that you can invest into, rather than a open fund where you can just buy whatever stocks you wanted. So it is a pro in the sense of you can reduce some fees, but you are restricted on what you can actually put into the portfolio. So bonuses wise, I am going to have to, again, give the point to the Roth IRA, because if you can get an employer match, you can essentially double the amount of money that you are putting away every single year, rather than in the UK. And finally, I wanted to go over the ability to withdraw and use the money if you need it. So for a Roth IRA, starting with America, we do have the ability to pull out your initial principal amount. So what I mean here is if you put $300 in, you can take $300 out tax-free without any issue. However, you are restricted on taking out any of the gains. So if you've put $300 in and bought a share, that's doubled in price, leaving you with $600 in your account. You can only take out the initial $300 without tax. If you chose to take out the additional $300, as far as I'm aware, you would pay normal income tax on that amount, and you'd also suffer an additional penalty of 10%. This generally incentivizes you to keep the money in there until you retire, because when you hit 59.5 years old, for some reason a half, but 59.5 years old, you are able to remove as much of the funds as you want tax-free without any penalties, providing you have had the account for the last 5 years. On the other hand though, we have the UK ISA, and except for the lifetime ISA, in the UK we can take money out of our ISA whenever we want. We can take the principal amount and all of the gains at any point, whether it's been a year or a decade since we started investing. There is no minimum time frame. You can put money in and you can take money out straight away if you wanted. So the one restriction we do have is with the lifetime ISA, and to take money out without penalty, we have to meet 2 requirements. We either have to be years 60 or over, so essentially in retirement, or you need to be using the money for your first house. So if you're buying your first house, you can take the money out without penalty. If you try to withdraw the money outside of those requirements, you don't get the government match. So if you've put £4,000 in, you get £4,000 out, but you do get penalised slightly. And generally what this works out is every pound that you've put in, you generally get around 80p back. So you do lose money by pulling the money out of a lifetime ISA before you meet those 2 requirements. So in this final case, I am going to give the point to the ISA for the UK. And this is mainly because even if we chose to max out the lifetime ISA, which is the more restrictive account, that still leaves us with £16,000, which is roughly $22,000 of allowance to spread across our other investment vehicles. And we can withdraw that at any time. If we put £1,000 in and it doubles in price, we can take £2,000 out tax-free without any issues. So overall, it is a tie on the tie board between the 2 different investment vehicles. We have 2 points for the Roth IRA and 2 points for the ISA. However, for me personally, with all of this information, I would rather have an ISA over a Roth IRA, mainly for the flexibility of it, and also the higher ability and higher amount that we can actually invest and save into the account. But again, this is entirely subjective. What would you prefer? If you could set up either of these accounts from wherever you are in the world now, would you rather pick a Roth IRA or an ISA? Let me know down in the comments below. And also, if you can, let me know where you're from. Let me know if you're from the US and you'd rather have an ISA, if you're from the UK and you'd rather have a Roth, or if you're from somewhere in Europe and you would rather have any of them more than what you currently have yourself. Let me know, it'd be really interesting to chat about. And if you want to know a little bit more about ISAs and have a little bit more of an in-depth look at ISAs, I would suggest checking out this video here where I go over it in more detail. And until next time, remember to invest, save, and subscribe.